Hey there. For beginning, myself and Paul just want to remind you that everything discussed here isn't a substitute for formal investment advice and does not represent the formal perspectives of Aquarium Investments. The content of discussion will hopefully interest you, entertain, and supplement your own perspective, but it's important that you conduct your own research or speak formally to a financial advisor before taking any risk with your money. Having said all that, we hope you enjoy the discussion and let's dive in. Here we are again, Paul. How are you doing?
I'm doing super well. How are you?
I'm great. And hello to everyone listening, of course. It's 2026. We're 22nd of January, and we're into a new year of chaos and fun and different things going on worldwide. So as always, I'm really excited to talk about what's going on, and I hope you are as well, Paul.
Always.
Great. So we've had a lot going on, even in the first 3 weeks of this new year. It's just been completely breakneck with everything that's been changing and happening. But how about, let's start with what we always start with. How about you give us, Paul, your main thing, your big event that happened in the last period since our last recording?
Well, for me personally, I guess it was my trip to Ireland. I got to meet you and the family and the friends, and it was something.
You know what? I'm after putting shame to myself by forgetting to mention that. So thanks for catching that. That was probably our biggest event of the last 3 months, right? It's we've had Paul over in Ireland. Yeah. And it took you to a rugby match, took you to Munster, so now you're indoctrinated into Munster rugby. So,
I have the shirt. So I'm one of
and you know what? You have the shirt, and what's for anyone listening, despite my best efforts, I couldn't get Paul to wear the shirt and take a photo of him with it. So
next time,
that was a bit of a letdown.
We'll do it next time for sure. So on a personal level, I guess this was the highlight because it was something new. It was very interesting. I loved the country. I've been to Dublin before, but never to the country, and it was very good. I enjoyed it a lot. So thank you. But on a kind of global scale, I guess for me, the end of quantitative tightening and a restart of what is effectively a QE operation. So, direct debt monetization on the central bank's balance sheet, meaning the Fed. I think it's very important. It was expected, but I think the fact that it happened kind of changes the way you should look at things in markets. So I guess that's important for me. What about you, Cormac? What was most important for you?
Well, now that I have the egg on my face, I'll come out. I'll be shameless and say my highlight was obviously having Paul visit us in Ireland. That was my biggest highlight of the year. My second biggest personal highlight of the year was I was very happy that we did a year of doing this podcast and recording it and trying to improve. And I think we did improve, me personally anyway. I even had some friends recently asking where was our latest episode, which is always a good sign because it means they're not delighted that you're finished. It means they're actually wondering, are you going to do some more? Which is
we shall.
Nice to hear. Yeah, and we shall, exactly. But that was a personal highlight. So I was very, very happy from the year having done that with you. And we've had the chance to talk about a lot of different topics. And as you said, we'll continue to do so. And we're going to explore more different ideas on what's going on in the world. So that's my personal highlight. But then in terms of what's happened on a more geopolitical level, I think Venezuela in the last 2-3 weeks, the removal of Maduro from Venezuela and the US actions there, I think is quite a seismic event. And it ties back into some of the previous discussions we've had. Our last discussion, we did some debate around South America and links to the US and Argentina and what that means for the rest of the world in terms of BRICS, in terms of Europe and so on. And I think that Venezuela and the actions that are happening in Venezuela actually tie neatly into that. So I know later we're going to talk about foreign policy of the US admin because I think it's probably one of the most consequential things going on geopolitically. I know it is, and we all know it is. But Venezuela is a good pivot topic for me which I'm going to touch on again a bit later. But yeah, that's been my big highlight.
Sounds good. A lot to talk about, right?
A lot to talk about. So today we are going to talk about our silver, and we're going to talk about gold and precious metals. And this, of course, is probably, Paul, your biggest expertise area. And if there's anyone to talk to about on this topic, it's you. So you're going to give us a bit of a discussion about this, a bit of a rundown on how gold and silver and other metals have moved in the markets. And then we're going to review a little bit on, as I said, US policy and what's happened in the US and globally from there. So that's what our topics are going to be today. And I think, Paul, why don't you lead us in with a quick overview of our key market assets as usual?
Sure. So we're starting off with the dollar index, as we always do. And what I've done is prepare these charts for the totality of 2025. And, the arrows, whether up or down, they show the performance of these assets for the year. We have January included in the chart as well, not the full month, but up to today. But the actual percentage changes are for 25. So it was a bad year for the dollar, as can be seen from this chart. Dollar has depreciated by around 10% from the beginning of 25. And it's a big change, we've touched on this before. Typically, the dollar would move maybe 4 or 5% per year on average, so it's a bit of an outlier. And this next chart, it actually shows you that it's been the worst year for the dollar since 2000. This is a chart from Double Line, which speaks volumes, right? Special year. So in that context, what's happening with precious metals makes a lot of sense, right? This chart is interesting as well from Bloomberg. It shows you the share of the dollar in global reserves, and you can see that it's been declining. The black line is the dollar, and then you have euros, yen, pounds, and gold. Gold is the gray one. So it's pretty clear that gold is replacing other currencies, and the dollar in particular, on central banks' balance sheets, which is critical, right? If you think about the reserve currency and the funding mechanisms and the collateral, it's super important, right? So a massive year for gold. It's up almost 63% for 2025, and you can see it keeps going. We're almost at $5,000 per ounce. So big year for gold. And this next chart shows you that it was mainly the central banks. It's actually two charts, but anyway, it was actually powered by central bank purchases, and it obviously ties in with the global reserves that we looked at. Silver dollar. Again, we're looking at spot rates here. So even a bigger year, up 140% for 25, and we are up another 30% in just January. So we've talked about this the last time, and it was always expected that silver would be catching up. In every cycle, gold moves first, and then silver just keeps catching up. This chart is interesting as well. It shows you the dollar and the gold-silver ratio. So the gold-silver ratio is the blue line, and the dollar is the white line. And you can kind of see the correlation. It's not always there, but typically you would have dollar going down with the ratio, right? And there is a bit of a dislocation right now. So the ratio has dropped, but the dollar...
Sorry, when you say ratio, Paul, you're talking about gold-silver ratio, isn't
Yes,
that it?
exactly. So it's literally gold divided by silver. And we've talked about this. The history of gold and silver is very long. Obviously, it's thousands of years. In a historical perspective, the percentage of price of silver relative to the price of gold would be around 2.5–3% historically. So even with this current move, we're not there yet. right? We're at about maybe 2% right now. So even on that metric, despite these big moves, there's still a way to go. This chart in particular, it just showcases you the potential for further falls in the dollar. Now, there's no direct correlation, obviously. The ratio is a bit abstract, right? But, just from a historical perspective, it's something to think about, I think. And I also think that the rallies are somewhat stretched. With silver, it's literally an exponent chart. So I get a feeling that there is a lot of FOMO out there. So, guys that would be very reluctant to get into these markets suddenly calling me and saying, oh, we should buy silver. So things like that.
Yeah, and I mean, Paul, I did pre-start this conversation by saying that you're probably the expert to talk to on this topic, and I know myself even, I do have some ownership of silver only because of your advice on this, really, and I know FOMO is a big thing driving people's insight and interest in silver at the moment. Obviously, we'll mention Bitcoin in a few minutes, but that's been a classic hyperbolic or exponential curve that people have made a lot of money off of trading in the last few years. And at the moment, it's completely plateaued. And instead, people are saying, a lot of retail investors in particular are saying, oh, maybe I should be in silver instead. And it has been definitely a meteoric rise, which has been fantastic if you're in it. And but it's a very interesting relationship I knew nothing about, and I know we're going to talk about it a bit later when we get talking about precious metals and industrial metals and so on. Yeah. But yeah, it's fascinating. And you're saying there that there's looking at the chart, there's room for gold to potentially decrease. But it's also interesting just looking at your chart. I see your ratio there that we see on the y-axis on the right. So you can kind of see the dark blue line maybe followed an average of around 60 or 65 in terms of ratio for the last 20 years. And then you can see a bit of a dip there recently. So maybe the argument as well is that this is a kind of catch-up that silver is doing on gold at the moment. So maybe that's also why there's such a meteoric rise.
Well, a lot of people out there are kind of momentum driven. So, as you say, they see something go up and they chase it, kind of thing. I would call these guys macro tourists. Your typical guys in Hawaiian shirts. So they always chase something. We are not like that at all, right? So, but the mere fact of it being all over the place, a lot of interviews with very smart people and, these guys calling me up, it makes me worry in a way. I still think both metals have a lot going for them, and I think we'll see them go up, I don't know, multi-year horizon, but I think it's time to be cautious on them. Yeah, but like the relationship of this ratio to the dollar is super important too, I think, and we'll see if it holds, but we're still dollar bearish.
So I think what people should take away from that probably is probably the biggest thing I'm taking away from it is don't wear a Hawaiian shirt when meeting you, because
never
you'll get nervous.
Not even in Hawaii.
Exactly. So if anyone's thinking of talking to Aquarium, don't wear your best Hawaiian shirt when you're meeting Paul. He won't appreciate it.
Yeah, I don't mind Hawaiian shirts generally. I just don't wear them. Okay, let's move on. So S&P 500 and Nasdaq, good year for these two as well. So Nasdaq went up by about 20% in the end, and S&P around 16.5%. So decent year. We had that dip on Trump's tariffs announcement, the Liberation Day. Most people forgot about it by now, but it was there. But despite that, we recovered nicely and showed nice gains.
So the sky didn't fall.
It didn't fall. Well, at least it didn't fall yet. But a few things I wanted to kind of showcase for in the context of the stock indices. And I found this chart interesting. It shows you price to book ratios. It's basically a balance sheet metric. It's one of the metrics. You can't base your investment decisions just based on that. But typically, the higher the ratio, the more expensive the stock is. So in this chart, we're looking at US price to book ratios, which are at 5.62. And then the global index is at 3.66, and then if you exclude the United States from that, it's even lower at 2.2. It just shows you the relative expansiveness of US relative to the world, basically. And you could look at this chart, which shows you international equities to S&P, which kind of shows you the same thing. This is a ratio as well. You can see which indices are used in the top left corner, so S&P 500 and MSCI EAFE index. And it just shows you how cheap
what is that index? Sorry, Paul, the MSCI EAFE.
It's an international equities index, so
okay.
So not US. And obviously, seeing it this low shows you how cheap international equities are relative to S&P, or you could look at it the other way around and say how expensive US stocks are. We can look at Shiller P ratio again. We've looked at it in our previous podcasts, and it's still there. It's still close to the very extreme, to the very top of the range. The extreme readings of 2000. So we're very close to all-time highs in this ratio. And it's also a sign of a relative expansiveness of US stocks. So it kind of it's one of the things that drives our process in terms of our allocations for 26 and further out.
And how do you determine? Well, I mean, maybe this is beyond. This is definitely a question that cannot be simplified. Or the answer certainly can't be simple too, but I guess how does one determine whether they should be looking at overpricing in US equities versus underpricing in the rest? Because of what your graphs are showing is that there's this pretty clearly on this chart showing this ratio at 0.43. You can clearly see it's at an all-time low based on the last 30 years, 40 years.
It's a difficult question because it has a lot of angles to it, right? So if you put yourself in the shoes of a foreigner, not a US citizen or business, and you ask yourself a question of whether you should invest in US or locally, say you're in Dublin, for instance. The reason why people invested in US is twofold. One, the companies in US are unique, right? So some of the bigger tech companies, and again, we've discussed this, some of the more innovative companies come from the US, but it's also the dollar. So if your currency base is in euros, and you invest in US, you obviously buy these stocks in US dollars. And for argument's sake, say you're not hedging that FX risk. Basically, if the dollar is going up, it adds to your performance. So if Nasdaq is up 15% and the dollar is up another, say 5%, you're really making 20%. The dollar's relative strength or lack of decreases against other currencies was a big motivator, the rest of the world to invest in US. It also made sense in the US-centric world where, you pay for commodities in dollars and you have these retained profits from trading and you have to do something with them. So typically you would go and buy US Treasuries for a safer investment and maybe US stocks for something more speculative. So a lot of these things are changing. We've looked at the dollar kind of decreasing. We see this concentration in US allocations by foreigners as well. But these things are changing, right? And it's the expansiveness of US does not help. Right. In fact, if you look at some, scientific studies of the index, they would tell you that, your expected return at these valuations are not good looking out maybe 10 years out. So historically speaking, of course, it could be different this time. So yeah, interesting, and it kind of drives our allocation these days. So we can look at EM stocks in particular. So also a good year, and you can see this outperformance. So 32% for 25 as opposed to around 15% for S&P. And we keep on going in January, right? We're still going up in January. And another comparison of EM stocks versus DM stocks, developed market stocks, also shows this. So we have two indices here. Well, okay, one is an exchange-traded fund. The white line is the emerging markets exchange-traded fund, and the yellow line is the developed markets large and mid-cap index. You can see that emerging markets are outperforming. I believe that it's going to continue this way in 26 at least. And it's something new. So this chart from GaveCal Research shows you that it's been almost 20 years since EM outperformed on a sustained basis. So a long time coming, right? And what you can also see is that typically it doesn't end with 1 year. It's a multiple of years, right? So
I mean, interesting spikes there in your chart. When was that? 2017 and 2025 were the spikes, were they?
Yeah, so it happens sometimes, this outperformance, but it hasn't happened for a while, and the last time it happened was in the period from 2000 to 2008, roughly, right, just before the crisis. Okay, so we can look at US rates, as we always do, and here we're looking at two lines as always. The white line is the curve today, and the blue line is the curve on the 1st of January of 2025. And basically you could see that over the year, the short-term part of the curve has repriced significantly. It makes sense because, the Fed has been cutting rates, so you would expect that. But the interesting part is that anything beyond 20 years tenor is kind of at the same level, so nothing has changed. And the 30-year maturity is actually higher than it used to be on January 1st, 25. So basically the long end of the curve was a pretty bad place to be in from a trader's point of view, of course. You actually lost money by being in a 30-year bond. And my expectation is for this to continue in 26. I think there's just not enough demand on the long end. There's no issuance on the long end. We started QE. I wouldn't be surprised if we saw the long end yields go up even further. Something to think about. And of course, as I mentioned, the restart of QE is an important thing, and I think these two charts showcase this very well. They don't call it QE, they don't call it quantitative easing, but essentially it is what it is. It is monetization of debt, basically. You can see how the balance sheet of the Fed is going up, and the left chart shows you week on week changes. These are a bit dated, but anyway. And the right chart shows you the totality of the Fed's balance sheet. You can see it going up, right? So to me, this shows what's critical, because a lot of people project this QE restart as a liquidity injection. But in all honesty, we don't know how this will be transferred into the economy. But what it does tell you is that there's a clear lack of demand for US Treasuries in the size that is required. We've talked about Doge, all these attempts at savings. Well, basically they didn't work. In order to keep the deficits going and financed, you have to monetize, basically. And we've said this many, many times, and now we're seeing it happen. Right, so very important.
Amongst other things as well, right? Because there is the whole discussion around the tariff returns and so on.
Yeah.
Shortening that deficit, right?
Talk is the right word. If you look at the numbers, we don't have these charts, but if you look at the numbers, you can see kind of customs duties rise. So there is some inflow from tariffs. but it's minuscule in comparison to the deficit, to the budget deficit. So it doesn't really change the necessities of the U.S. administration. It's not bringing in the money in the size that is required. So I would say it's not working.
Okay, because I thought there was some news there recently that the trade deficit in the U.S. is the lowest it's been since.
That's true.
Since the crash, since 2009, right?
I'm not sure about 2009, so I'm not going to pretend that I'm aware. I have to look it up. But yes, it has been improving. But the question you have to ask yourself is why it has been improving. And in fact, trade data has been influencing a lot of different things, like the GDP readings. They're very much influenced by imports and exports. So, and look, it might be better, but it's still a deficit in trade, right? And it's humongous. It's just not as bad as it used to be, and we'll see what happens next.
I get, I know what you're saying. You can't. If it's still negative, it's still negative. It's not like you're suddenly.
It needs to be financed, basically.
I get you. Yeah. I find it funny. I do think I find it. I guess I have a personal bugbear with with some of this discussion. You have to say that when there's a general trend in the right direction, it's probably for the benefit, and if they continue that way, it's for the benefit, the long-term benefit. But I know what your point is. It's not positive yet. It has to be financed. I get you.
It's not positive. I think the last time they had a positive budget deficit was during Clinton.
It was during Clinton, exactly. Clinton era, yeah.
Yeah, so in terms of trade deficit, I'm not sure when it was positive even. But look, it was always the deal, right? Americans have the reserve currency, everything is traded in dollars, US treasuries are the collateral market, you can trust them, they're not going to take it away, all this stuff. But the other side of this is that you are destined to run trade deficits because your export is the dollar, right? And so it actually makes sense for it to be this way. But when talking about tariffs, there's no direct link, I would say. And again, a lot of these moves have been influenced by the tariffs, these moves in trade deficit, I mean. So, yeah, I wouldn't read too much into that at this point, not yet anyway. So we could look at this chart when talking about rates, and this chart compares 30-year yields for US, European Union, Japan, and China. And the interesting thing is that, and typically 30-year tenor is the longest for these countries. I don't think they have longer ones. I think a couple of countries in Europe have them, like I think Austria has a 100-year bond or something like that. But typically 30 years as far as it goes. And you can see that all long-term yields for all these countries or geographies have either stayed elevated or actually went up. In particular, you could look at the yellow line, which is the Japanese 30-year rate, which has spiked recently a lot, and there's a lot of chatter in the markets about this and the implications of this. But I think it's important to understand that the problem of elevated yields on longer term rates is a global phenomena. It's not just US, Okay, we can look at EM bonds. Also very good performance for emerging markets. I'm sure the fall in the dollar had a lot to do with this. So up around 11%. We could also look at the relationship of emerging market bonds and the dollar. So we have a comparison of the dollar and the EM bonds index on this chart. And typically what would happen, like they would move inversely, right? So if the dollar is up, it would be bad for emerging market bonds typically because most of their financing is done, or at least used to be done, in the dollars. So,
Yeah, your purchasing power of the dollar becomes weaker, right? So it's,
It's not so much because of the purchasing power. It's more to do with the needs to find the dollars for emerging markets countries. And normally emerging markets would be producers of oil or some resource or something like that. And the trouble would come when the dollar is scarce. right? So when the dollar goes up, it becomes more scarce. The point of this chart is to show that this relationship seems to have gone by now. You can see these not huge, but like upticks in the dollar that didn't influence the emerging market bonds. So it seems that this relationship has broken, and it's very important to me, at least.
And why exactly is that so important? Could you just elaborate on that a bit?
Well, because this relationship has held for a very, very long time. And I think the fact that, it's still up for debate, maybe it still works this way, but it seems to be different right now, at least in 2025. So if this has changed, it would tell you that the role of the dollar has changed, and the way emerging market countries finance, or what kind of other options they have, that would influence this relationship.
So you're kind of saying like a pivot away from the dollar being just the primary trade currency.
Yeah. So like, for instance, we have a lot of emerging market countries financing in yuan, in the Chinese yuan. So I think that is one of the reasons. So even if they don't have the dollars, they can go to China and kind of get the financing there. I think that's what's happening, really.
Yeah, I mean, I guess that reflects an overall general geopolitical movement in general, doesn't it? Because we're talking more about US becoming this isolated, self-contained unit, or maybe not even isolated, but hemispherically aligned unit.
I don't think US is isolated. It's still a super important economy, interrelated globally. It's still out there. It's just the dollar and the US Treasury complex. How important is it? What role does it play? That's the difference. And I think this role has been jeopardized, or it's been diminishing since 2022. Since the freeze of the Russian reserves. So I think that was the breaking point, and it developed from then. It's not a pristine collateral anymore. That's the thing, So very important for us, and in the way, and for the way we think about allocations and what's going to happen to the dollar, and basically what we invest in. So I just wanted to highlight this break in relationship. Okay, and we'll finish off with Bitcoin, our favorite. Again, we're looking at yearly performance, and if you remember, at the beginning of the year, there was a lot going for Bitcoin, right? All these talks about the strategic reserve, and constant pumping by Trump himself and Melania, the Trump coin, the Melania coin, and Trump's kids and everyone, and the crypto tsar. And it seemed like this administration is going to push for it, right? That they're going to do something about it. But nothing happened. There's no strategic reserve. There's no kind of systemic importance of the industry. And I think we see this in the performance of Bitcoin. It ended up down on the year, right? Just marginally by Bitcoin's standards, but still minus 7.5%. It feels like it has decoupled from Nasdaq. So we're back to this conversation and discussion whether it's related or correlated to Nasdaq, and we'll see. But since October, it's just the relationship is just not there. We have another chart on Bitcoin, and we compare gold to Bitcoin in this one. And there's a lot of talk about Bitcoin being the digital gold and all that. But they have decoupled, I would say. So
the interesting thing, just to highlight on your chart, I think it's actually worth pointing out, is that you've got two different axes on the left and right. So we're looking at two different scales of gold and Bitcoin, and I know that if you scale them similarly, the drops and dips around major events is a bit more noticeable, and it actually demonstrates this kind of non-correlation or inverse correlation between the two assets, which is, I mean, for me, look, I have a very, very, very small amount of Bitcoin. I'm in it for the fun of it. And it seems that every time I buy it, it just plateaus completely. So So I'm probably one of the people responsible for the Bitcoin market completely flatlining for the last few months. But other than that, I just find it a very fascinating human study and kind of behavioral study, because the debate all along has been, and we had at previous times, was whether Bitcoin was this decentralized commodity that people would trade separate to central governments and have it as this completely removed of commodity that could avoid inflation and so on. But then at the same time, loads of people are saying, well, they want the US government to set up a reserve, and they want various governments to set up reserves of this currency, which makes it inherently, then it starts becoming centralized, because they control the vast quantity of it, and it becomes they can dictate prices by just saying, pumping and selling. And but in recent weeks, this kind of flatlining versus the behavior of silver, behavior of gold, behavior of other commodities and assets indicates that it maybe is not trading as a hedge against uncertainty or inflation or so on, but just being treated as another tech asset, really. Obviously, you've pointed out that there's a decoupling between the Nasdaq and itself, but at the same time, its behavior, I think its trends are quite similar to tech stocks still, right?
Yeah, I still think it's closer to a type of tech stock or subsector in the tech industry than it is to gold. It's not a currency. It's not a reserve. At least not yet. So yeah, but it's interesting to keep track of it, and we are not really investing in Bitcoin, but it could be an interesting liquidity play in certain circumstances. So in fact, I think that our approach is more flexible. It actually allows us to trade it, but we don't have like. I don't know, a religious approach to it. It's just an asset.
Yeah, you're not part of the cult.
I'm not part of the cult. I'm not part of any cult, not even the silver cult. I'm not part of any. I think you have to stay kind of in line. You have to adapt to markets rather than, have strong beliefs.
I was hoping, Paul, that we might see you posting Michael Saylor-esque memes of yourself with glowing eyes and saying silver's going to the moon or something like that. I thought that might be your next phase.
No. I'm too old for that. I'm sorry. No, not going to happen. Unless you ask me to do that, maybe I'll do it then. No. But not out of my own will.
Okay, that's a very comprehensive breakdown. Obviously, it was before the new year since we last reviewed things, so it was worth digging back into things. And you have a few new charts in there, which kind of gives you a very broad understanding of how markets have moved in the last several months. But probably more importantly for you personally, and for, I guess, the name of this podcast, I want to ask you how Aquarium did and how you've performed in the last few months.
It has been a very, very good year for us as a company, and a very, very good year for our clients. Basically, we were prepared and ready for what happened. I think we still are, so I'm pretty sure everyone is pretty happy.
I think you've done pretty well, and I think knowing you, Paul, understating how well you've done is probably one of your approaches. But I think it's fair to say Aquarium have done quite well in the last year. So well done to you on that.
Thank you. Yeah, I mentioned this to you. I think staying humble is very important in life generally, but also when you trade. It's very easy to become full of yourself and and start making mistakes. So
you're a regular Gandhi, to be honest, Paul.
Latvian
regular Gandhi. Market Gandhi, yeah. That's
Latvian market Gandhi. Okay.
Latvian market Gandhi, but no, that's fair. It is important to stay humble, and I think that's actually a really good segue into discussing the rest of our topics, because being humble and being able to step back and look at how things are moving is actually very crucial if you're going to try and understand how markets move, or how money moves, or how any of it moves. And I know myself and yourself, I think we both share the MO or the ethos that systems and how things move and changing of systems is more a motivator for us than getting caught in being right or wrong. And the last few weeks and last few months of observing the world and geopolitics has been a good tester of that. It's can you admit that you're getting things wrong, or do you see the system changing, or are you able to step back and say, this is happening, this isn't happening? And obviously Aquarium have done well off the back of that. But yeah, that kind of leads us into maybe talking about the rest of our topics for this discussion.
Yeah.
Would you agree?
Yeah.
Okay, so then how about we talk about developments in 2025, and how about we review what has happened? In particular, why don't we start with the precious metals rally, why it happened and why it was so important?
So for me, it's basically a sign of regime change in terms of how the monetary system works. And I think what we're seeing is basically a direct competition of gold with US Treasuries and the dollar. If this is true, it means that going forward, things are going to be very, very different to what they have been. So one of the mistakes I think a lot of people make in the markets, they kind of look at the past, they like to look at charts, and they project whatever happened in the past into the future. But given this change, I think it's critical not to do that. So, and if you look at what has been performing for the past 10 years, it's literally US and US tech, maybe Bitcoin, which is, as we've discussed, probably a subsector of that. So big change. And I think it's the gold's rally just shows you the actual debasement of the currencies rather than, a move up in gold itself. And it's clear that global central banks are buying gold for reserves, substituting the US Treasuries for gold. I think the case of Japan is interesting because they're actually the country that doesn't have any gold reserves, and all they have is US Treasuries mainly. So no gold in reserves, and they have been adding US Treasuries recently. We actually have a chart in this which compares Chinese Treasury holdings to Japan's Treasury holdings, and so the white line is China, and the blue line is Japan's central bank. And you can see how the holdings of China of US Treasuries have been declining steadily, and Japanese have been kind of flatlined for a long time, but we see a small pickup lately. So they kind of go in different directions. So maybe Japanese are substituting Chinese demand. But it seems to be leading to some problems because the yen is falling. We've seen the rise in long-term yields in Japan. And paradoxically, it could lead to sales of US Treasuries and consequent US Treasury market volatility. So I think it's very, very important. I don't think it will change in the sense of this replacement of one versus the other. Silver is just a smaller brother of gold, right? It has more industrial use. It's not strictly monetary. But gold is monetary, and it is the reserve these days, and I think it will stay that way.
So what fuels the coupling between silver and gold? Because we talked earlier about the ratio, and I mentioned there that silver is basically chasing after gold as gold increases in price, and this rebalancing of the ratio is what's going on, it seems. But why is there that coupling? Is it just because literally they're two precious metals?
So I think it's a lot to do with history and the way things work. So I can only imagine, but probably guys who missed out on the gold's rally see opportunities in silver, which was underpriced for a long time, right? So I wouldn't call it decoupling, it's just cycles, and like if you look at this dollar versus the silver gold ratio, you can see that it happens, right? And the last time this happened was in 08-10, right? When silver was outperforming gold as well. For us, we still look at these three metrics that I mentioned before in terms of how we assess whether there is a top in precious metals or we're too high, And these metrics are the same. So, the rate cycle, in particular in US, so rates have been decreasing, but we're not at the end of it, right? We're maybe midway. It's not over. We'll still see cuts in rates in US. And the second one is volatility, which has increased for both gold and silver, but we're still not at the levels where you could say, okay, it's historically what told you that the top was in. And the third one is the gold-silver ratio itself, right? So again, we are closer to these historical averages, but even on this relatively short period of time, you can see that it's not the extreme reading, right? So there's more scope to go. And all of this tells me that the top is not in, that we'll still see gains, I guess, over the years. But I do expect a lot of volatility, meaning moves both ways, maybe big corrections or kind of wide consolidation in these metals. But those would be opportunities. It's just a matter of being ready for them. And also, there is a kind of second derivative of this, which is the mining stocks, right? The actual companies that mine silver and gold. They have had a decent rally as well, so comparable to the gains in silver. But given where prices are, and even if we don't see more gains in these metals, but like say they stay at these levels, at current levels, the kind of cash flow these companies are generating means, they are still relatively cheap, right? Like, to answer your question, I think it's basically the regime change. I think it's a change in the monetary system, and I think it's here to stay.
Okay, so then what else was different in 2025 and what's developed?
So I think what we've already mentioned, so the emerging markets performance is very important because it could lead to the continuation of this process, right, in this rotation. I think the repricing of the dollar was very important too, and it raises a bunch of questions. For instance, what's this administration's policy on this? Because it seems to be a little bit contradictory. Like one day Trump would say, oh, we need a lower dollar, and then Bessent would come in and say, oh, no, the dollar needs to be higher. So there's a bit of confusion in that sense. But I would say that if US wants to produce critical goods locally and export some of them, then definitely they need a lower dollar. It's also a big question whether we'll see foreign capital outflows if the dollar keeps going down. And if that happens, will we see capital controls in US? So obviously geopolitics doesn't help with this. All this stuff about Greenland and the Davos thing, it's not helping build up confidence in US assets, right?
Yeah, I think though that you and I probably part in terms of perspectives on this because, well, we do and we don't in some ways, because I know in some of our previous discussions, and as I mentioned earlier, you and I share a very strong motivation by the idea of getting your system right rather than necessarily, money per se doesn't motivate us really as people, and things like that don't really motivate us. But I know that we both appreciate the idea that systems need to change and they need to stand on their own two legs. And I think in one of our previous discussions, we did discuss this, that it's like for many years post-World War II, the hegemony has been the US and it's operated in a certain way, whereas in the last 40 years, 50 years, the increasing outsourcing of production in the US and the shipping of most of its industry to China or India or elsewhere has had quite a seismic effect on US economy and the US performance, and most of its production has been outside of the US. And this is basically the drum that the US admin have been banging for a while. And even, indeed, you mentioned Davos, Howard Lutnick, the Commerce Secretary for the US yesterday or the day before even, basically came out and said, well, globalization hasn't worked for the US. It's harmed a lot of our US citizens. The idea of making cheap products in the East off of in what is some circumstances is quite essentially slave labor, and then selling them in the US for large margin gains hasn't benefited the US as a country. And I think you and I both agreed that realignment of that system is something that was inevitable, that they had to have it happen, because the dollar was becoming expensive, the deficit was getting larger, the amount of treasuries they were issuing to stay on top of the deficit was getting even more, getting larger. So there had to be some sort of system change. And I think I know what you're saying in terms of confidence. People say, well, is it this, is it that, is it not, is it, what are they on about? But this is part of the kind of the breaking a few eggs to make an omelette, in my perspective.
I do agree with Lutnick. It's probably the only thing I agree with him on. But it had a bad influence for your middle American, your average American, for sure. And it needs to be changed. But the questions that I've raised, they're more to do with the dollars repricing rather than the the bringing of manufacturing back home, or building critical stuff back home, because it influences decision making in a mathematical fashion. So imagine yourself investing in S&P 500, and you're Irish, right? So your currency base is euros. We see a repeat of 2025, so S&P goes up 15% or 16%, but the dollar, for instance, falls 20%. You effectively down 5%, right? So if it happens as a one-off, it's one thing, but if it's a trend, it's another thing. And that influences your decision making. It influences how you allocate your capital, and it could mean the outflows from the U.S. of the capital. It's probably not a disaster, but capital inflows is what kept U.S. stock markets going up, right? It's not just domestic demand; it's the world's demand. So if that changes, it could lead a much different outcome than investors are used to. I don't think people pay enough attention to this. I think people are kind of conditioned to euro-dollar being sort of flat. Okay, you have an odd year of outliers, but generally there's reversion to mean. If that happens, if that changes, it's a different story. It changes the investment dynamics. That's what is interesting to me. I'm not really interested in the internals of U.S. social fabric or something like that. I mean, it doesn't help me with my job, right?
It does and it doesn't. I mean, probably you're fair enough for you. You're approaching it from a very professional perspective, I guess. Maybe for someone like myself, who's a bit more layman and retail and looking more at kind of general sentiment moves, I do observe a bit more of the kind of cultural discussion around things and how things are moving geopolitically. But I understand what you're saying in terms of numerics. It's you don't need to get dragged into the weeds on that front.
Well, you could, but it's not helping me do my job, right? These are interesting topics, and I think what has happened in US over the past 20 years is interesting in itself. But it's more of a discussion topic, something to have a back and forth about, or something like that. But what I'm trying to do is look at things that are different in 25 and that could be influential going forward, right? So I think US is undergoing a lot of change. A lot of it is difficult to comprehend, but it's change. So positive generally, I would say.
You know what? It's so funny because just that exact point is probably one of the most cultural argumented points at the moment I'm seeing, because I see a lot of people saying the argument that nothing has happened. That the classic one is the Trump taco is what we hear about, and I know that's one that you reference sometimes, Paul. And the taco, by the way, for anyone who doesn't know what it is, it's Trump always chickens out, and it's alluding to this idea that no matter what happens in the US, no matter what Trump talks about, he doesn't follow through on any of it, and it reverts to the mean again. But I mean, I personally, again, we talked about, stepping back and can we see the broader picture here and stay humble. I personally feel like that there's been so much change that it's everything that he does and everything that the US does at the moment is of consequence. And indeed, I know what typically happens is the US come out with some kind of policy perspective, and you mentioned Greenland there, and that's obviously been the big one for the last few days. But Trump comes out with some kind of policy perspective, oftentimes in a really ignorant way, really brash way, upsets a very lot of people, as his nature seems to be. And I'm not one to defend. Yeah, that's the point. You would argue, right? Because I'm not one to argue the merits or the demerits of what he's doing. But I think one of the funniest arguments I often hear from people is that he's not done anything, and I just think that's categorically wrong. And if you're to step back and to actually observe how geopolitics moves, and then therefore how the US moves and how Europe moves and so on, you just can't say that they've done nothing. Like they're doing something every time. He'll come out with something really, really provocative, upset an awful lot of people, and then they'll have some kind of discussion. And then usually there's a row back, and this ties back into, for anyone that's ever come across the book, the Art of the Deal. I think that's basically the premise of everything he does. So it's like US are operating in this sphere at the moment.
It's literally his book in practice.
It literally is books. So they're operating in this sphere where everything they're trying to do is push forward something radical. People get very upset, and then they reach a middle ground, and that keeps recurring. And there's a lot of changes across the West, a lot of big consequential changes across the West because of that. And if anyone wants to make sure that they're staying ahead of the markets and how money's moving, and that they're on the ball, and that they're staying ahead of what happens to them in their own country as well, you kind of have to recognize that is happening all the time. There is something of consequence changing all the time. And that's, again, to be clear, not passing judgment on the merits or demerits of anything that they're doing, but so much has changed in my eyes, right?
Yeah, well, yeah, I agree. You can't argue that he's doing nothing and he's achieving nothing. There seems to be some rationale despite all the chaotic moves. And whether things get done or not, it depends. Like, you have to be Trump to know, because nobody knows what his goals are, right? And I think this administration is actually smart enough to understand that the world has changed, right? So in terms of monetary stuff, in terms of the role of gold, what the dollar is and how it's used in the system, in the global system, I mean. So I think they understand all of this. But the transformation is just so big and global that you really can't sit down and just sort everything out in one go, right? I think it's a decent process. For instance, I'm happy to see that US and Russia talking, for instance, because it gives me hope that the war will end, right? Because it can't end without parties talking to each other. So that's positive. Venezuela, Greenland, all this stuff, I mean, that's debatable. But again, it's a way of saying, we're a big player. You will consider our, wants and needs, and you have to talk to us. You have to come to an agreement with us. So I don't dislike the guy. It's just he talks a lot.
Yeah, I know he does. In fairness, he does. I can agree with you entirely there. I mean, he's an ignorant character, and he's rude and brash and so on. But I think when you step back from the emotive element of it, where most people just dislike the guy, which I understand completely, it's and you step back and you try and understand what exactly is happening, which is absolutely crucial to do if you're trying to have an objective understanding of what's going on here. And just on that, because it is funny that, something happens one week. We're 3 weeks into January, and there's been so many things that have happened. There's been the Venezuela stuff. There's been obviously the whole thing about Greenland. And this is week on week. There's some sort of seismic geopolitical change. And In 1 week, it was the removal of Maduro from Venezuela. And then the second week now, he's got some agreement with NATO and potentially Denmark. It was announced this morning that, parts of Greenland would be assigned as sovereign to the US and that they would be able to set up their military bases in Greenland on that basis. So there are these big geopolitical seismic changes happening at such a rate. But what's interesting is, I was reading some reports that even despite all these movements, there was a JP Morgan report, actually, I think it was, I was reading, that they analyzed 80 years of data. So that's since World War II. And they've compared equity returns to quiet periods versus active periods. So when some major geopolitical event is happening. And the report that I was reading said that while in the short term things may underperform, the 6 to 12 month equity returns after some sort of geopolitical shock are statistically indistinguishable, quote unquote, from other periods. So that implying that geopolitical events often don't actually matter as much for long run returns. And then this was again similarly, I was very interested in reading about this recently. It was the International Monetary Fund, the IMF, issued a very similar report in 2025 in April, saying more or less the exact same thing, that the geopolitical shocks don't actually have as much of a consequential effect as people would think. Now, that's not including military conflicts or supply shocks, like if there's oil shortage or some country invades another country, that can have a big pronounced effect. But in terms of these like geopolitical agreements and slight upheavals, which people are getting very, very animated about and they're resolving very quickly, it doesn't actually have that much of an effect. So I thought that was quite interesting.
Are they looking at stock prices or general markets? Because that's critical, right?
I can call out the two reports for anyone that wants to listen is quote unquote for the JP Morgan one. How do geopolitical shocks impact markets? May 2024. And then the second report was from the IMF was geopolitical risks, implications for asset prices and financial stability, April 2025. So if anyone wants to dig into that a bit more, those I thought were two interesting reads. To answer your question in short, Paul, I can't remember.
We can post the links in the video, with the video. And I'll have a read as well. It's interesting. So, another thing that I think is worth pointing out for 2025 is the performance of commodities generally. It has been a good year for commodities. So it's not just silver or gold moving. It's also copper, a bunch of industrial metals, platinum, palladium, things like that. And I wanted to show this chart, which is the Bloomberg Commodity Index. It's a weighted index, and it's got a bunch of different commodities in there. But oil is the big one. I'm not sure how big of a weight it has, but maybe 30 to 40%, something like that. So a lot of it is like oil related. Even with oil staying relatively low, it's still showing signs of resurgence. And I think it's going to be a big theme going forward. In particular, oil, I think, is going to surprise a lot of people. It's very hated at the moment. There's a lot of talk about, gluts and things like that, which don't really have any basis in reality.
What is that? Sorry, a glut? In what way?
A glut. It's in a way that there's too much oil.
An oversupply or an over demand?
An oversupply or lack of demand. It depends how you look at it. But it's been relatively low. It basically stayed in this range of, say, 60 to 80 for 3 years now. Closer to 60, so kind of flatlining. For us, it's a big theme, energy in general, but oil in particular. I think that's important, that's kind of different, and you can see from this chart that, and again, it kind of correlates with what we've shown before. You can see the emerging markets performance, which is heavy in oil and commodities generally. So you can see the latest rally, the latest bull cycle for commodities was from 2000 to 2008. And since then, commodity prices have been going down, down, down for a long, long time, which has a direct relationship with inflation, or deflation rather in this instance. So my point is, if we see a commodity bull run on the scale of, say, 2000 to 2008, this should have implications for inflation as well. And this next chart from Bloomberg kind of showcases this. It shows you CPI, the Consumer Price Index for US, and it's a black line, and the yellow line is inflows to all listed commodity ETFs. There seems to be a lag, right? So inflation kind of follows commodity prices, and well, in this case, it's the inflows, it's the capital moving into these ETFs, and I think that's right. I think that's likely. That's what's likely going to happen. And we could look at this chart, which is again the Bloomberg Commodity Index versus the US CPI, and it shows you this, and it's a wider chart, right? It's from 95, so it shows you the same dynamic. There's a pretty tight relationship between prices and commodity prices, right? You would assume it's that way, but this illustrates this. So a lot of reasons to be cautious in that sense, because with the Fed cutting rates, and generally globally we see rates going down, it seems to be happening at the very time when commodity prices are going up and inflation is likely to go up. So it's counterintuitive, right? It should be the other way around. If you're expecting inflation to go up, you should be hiking rather than cutting rates. So this dynamic could influence the actions of central banks a lot, and I think it will. So yeah, I think that's very important, and a big change from recent years, and something you should consider. And also this chart, which shows you commodity ETF share of all ETFs. Again, it's a bit like a ratio, and it shows you how allocations into commodities are very low amongst the investment public. So, even tiny changes in allocations could make these moves in commodity prices quite extreme. And also, obviously, when we're talking about energy, AI stuff, all these data centers, they play a role too, right? I think it's the place to be, basically. I think you'd be foolish not to consider at least some exposure to this. I think it's very important. I have a few charts on Venezuela, by the way, since you mentioned this. We could look at those. So this one, it shows you Venezuela government bonds. And this bond in particular is a bond that was supposed to be was supposed to mature in 2022, so 3 years ago, and it didn't because of the sanctions and basically the inability of Venezuela to pay their US dollar denominated debt. But you can see how it's been spiking, right? The price of these bonds, they're still liquid, they're still trading out there. So the price has doubled, and if you look carefully, you'll see that someone has been buying these bonds throughout the year. For instance, we started 25 at about 15 cents per dollar, and we're trading at 43 right now. So what it shows you is some belief by the market participants that some sort of agreement will be reached, and some sanctions will be lifted and some restructuring of this debt will happen. Coming back to what you've said, I think it's a positive sign. And again, in terms of whether Trump is doing or not doing something, it looks like some sort of deal will be reached at some point, despite the operation that took Maduro to New York. So I think you have a chart as well, comparing Venezuela to Poland.
Yeah, this was a chart from their divide when how Poland economically performed post leaving USSR versus Venezuela, and how they've performed. Now, obviously, there's some people will talk about sanctions and how Venezuela has sanctions on it, which impacted it. But I actually don't have the overlaid version of the chart, but someone did another version where they did overlay the actual timeline for the sanctions. And what this chart indicated was maybe a bit more of a reflection of the impact of Chavista socialism on Venezuela versus Poland, who became a free market economy. I wish I had the overlaid version. Unfortunately, I don't have it here.
So sanctions definitely played a role in terms of how Venezuela progressed economically. It limited investment in their biggest industries. They couldn't pay interest on their debt, etc., etc. But you're right in a sense that Chavez was very, how shall I put it, easy with the money. So at the time when Venezuela was producing a lot of oil, they subsidized a bunch of Caribbean countries, literally burning money in their socialist kind of push. So that didn't help. But you should keep in mind that Venezuela is pretty rich if you think in terms of resources. So it's not just oil; they have a bunch of other stuff too. On the other side of the spectrum, Poland. Its rise is basically the effect of it being in the European Union, I would say. It had a lot of help rather than as Venezuela, for instance. So I don't think they're directly comparable. But yeah, it was not all smooth sailing for Venezuela, even when they made the money. A lot of mistakes have been made at the time. And actually very similar to mistakes that the Soviet Union made when it was in a position of strength, also subsidizing a lot of your partners at ridiculous prices and things like that. So yeah, it's not just the sanctions, but
I would argue I would probably go a bit step further than you in terms of mistakes. Because I personally have a huge issue with socialist state policies, that how they affect people and their quality of life as well, not just their GDP and their performance. But I guess we can not perfectly align on that, the metric, the degree to which we believe that. But but that's fair.
Yeah, look, again, I'm not a socialist by any means, so I don't approve of the current structure at all, but you can't expect the country to do well when it's limited in what it can do. It's definitely a drag. In terms of social impact and what Venezuelans think about this themselves, I think it's better to ask them. I don't have an opinion, but it's pretty unlikely they're happy
with which,
with the socialist structure. I don't think they're
I think this is just something that I at the beginning, when I alluded to as a big movement or a big event that's happened in the past few months. It kind of touched on what we talked about last time, which is part of this grand geopolitical restructuring going on anyway. But we talked last time about Argentina and South America and how they were performing, and we had some debate about whether Milei would be still there or not, and what direction they're going. And since then, obviously, he is still there, but there has been for now. But there was also another election recently in Chile, where another right-wing government was elected, and from what I understand, the people that do vote for these right-wing governments, they're increasingly frustrated. Now, I'm not Venezuelan either, and I'm not from South America, and I have no real links there, to be honest. I played sports with some Venezuelan guys, so I'm still friends with them on Instagram, and they were celebrating when Maduro was removed. But listening to people recently who were talking about the way South America is going, there's this, from what I understand, an increasingly Machiavellian perspective that comes from a lot of frustration about security, about ability to buy things. I know in Argentina, for instance, they had a 200% inflation, and I think now it's 20%. So it's not solved, but it's a significant decrease. And then in terms of criminality, there's this which is what the US keep referring to, this issue with drug cartels and drug movement. And from what I understand, like cocaine consumption and drug consumption has increased exponentially in South America. I think Brazil, we're accounting for now 3% of global cocaine consumption or something like that, which was up from whatever they were before. And then beyond that, South America, apparently another stat that I thought was interesting was South America has 8% of the world population, but 30% of global homicides. And from what I understand, there's this kind of general frustration and understanding within a lot of these South American countries that they don't have to live like that. And there's a belief that maybe they could pivot away from some of this socialist policies, even if there was punitive action and sanctions on Venezuela by the US. It's not like the citizens were experiencing any great existence. And I would, from what I understand, this kind of rightward movement that's happened in Argentina, you've got El Salvador and Bukele, who's their president, and now Chile moving to the right, and then potentially Venezuela aligning with the US. And then there's talks of Colombia and Cuba as well being challenged by the US as well, that there is this kind of hemispherical realignment between North America and South America. And I'm going to claim this prediction because I've been saying it for the last year that this realignment of North America and South America was happening, and it was a bit more quietly talked about a year ago, but now it's out there outright, and I'm going to claim that one as a win in terms of predictions for me, that I keep seeing the US wanting to realign with South America. And then I also think it's actually going to happen in the Middle East with Saudi Arabia, and I think there's a whole pivot going on there. But yeah, the Venezuelan one is interesting to me just because it kind of represents a start of this realignment that's been going on, and it feeds straight into this discussion that's been going on the last week about Greenland and USA wanting control of Greenland as well. Just interestingly, this actually comes from a thing, because I've been reading up about this. It comes from this Monroe Doctrine, which people have been talking about a bit recently. And I believe Mr. Donald Trump referred to it as the Don Roe Doctrine because he wanted to claim it as his own. But
he's a winner.
He's a winner, but you can't argue with his gumption, his gall.
Well, it caught on. Everyone is calling it that now.
Yeah, exactly. But it kind of comes from this belief that the US should be free from influence of EU and other nation or large entities asserting dominance on the US. And I think that was a pre-World War II ambition. So they're just realigning to that again. And Venezuela kind of, for me, was like to get the even more push the ball rolling. Like Argentina and El Salvador were the first ones, and now Venezuela's the next one. Chile has a right-wing government now.
I think Chile was kind of US oriented anyway, kind of Western oriented. I think you're right. I think there is realignment, and I think it will be important to see what happens with elections in Brazil and Colombia, which are pretty close. Cuba is not a big player, obviously. It's a very small place, and with Rubio being the foreign minister, he has a special place for Cuba in his heart, right? So it's important because of that mainly, I think, and very close to US as well. But it's again, I try to stay focused on markets. So with Venezuela, this whole thing was actually positive for us because we do hold these bonds of Venezuela, and we have for a long time. So I follow it pretty closely. In terms of influence, well, I think it makes sense for US to influence, the Western Hemisphere. They are the biggest economy and the most powerful country there, so you would assume that they would have influence there, right? It's just logical. The way they go about it, we'll see. So, for instance, Venezuela, it has been a pretty good trading partner for a long, long time. And the stuff that I mentioned about Chavez spending the money on socialist programs, Well, that money came from selling oil to U.S. refineries, right? So there has been a history of successful cooperation, and I don't see why it can't happen again. I mean, it's from the point of view of U.S., Venezuela is right around the corner. Their refining industry is tailored for that type of oil, and it's the oil they produce is very specific, right? It's heavy crude. It's got a lot of metal in it, a lot of sulfur. It's not for everyone, right? It's you need the capacity to refine it properly, which U.S. does have. So I don't know. I'm hopeful that it gets resolved, that sanctions are lifted, and trade comes back. Right. In terms of Maduro and what happened, I'm not sure what happened actually. It seemed to be very theatrical. I'm not sure, right? But the big question is, has anything changed politically inside of Venezuela? And I don't have a good answer for that. I guess time will tell.
I think no. I think no is the answer to that one right now.
Probably no, but it's like that saying, the famous saying, look at what they do, not what they say, right? So, for instance, for me, if I see some sort of economic agreement signed, or sanctions being lifted in totality or gradually, that would be a sign of reapproachment, right? Something that actually influences your economy, and I hope that happens. I hope that U.S. just trades with everyone on some level and to mutual benefit. So maybe this happens, right? But
maybe it does.
Yeah. So again, I'm trying to stay focused on markets rather than ideology. But yeah, Brazil and Colombia, elections there will be important and to discuss on that front. Argentina, I know you have a soft spot for Argentina. We've discussed this, but I think it's too early to call still.
Yeah.
So yeah, but we'll, as we've decided before, I think we'll come back to that at some point, and maybe we do it on the back of the election processes that are coming our way, and just look at South America in totality.
I think it's fun because we've kind of drawn our lines on this a little bit, because we had a discussion about BRICS the last time, and Argentina and what would happen in South America with respect to BRICS and the US, and it's we've laid out our stalls. So I've come down on the side of the melee side, perhaps, and you're a bit more skeptical of it. But
I'm very skeptical about the guy. I'm not skeptical about Argentina. I like Argentina, but this guy, I have some reservations. I have a chart on South American trade with China. We can look at that because I think it kind of ties in with U.S. ambitions there. And it's a bunch of charts. Basically, it's it shows you that they show you that China is the bigger export market than the U.S. for South America. Virtually all Latin America countries depend on China for imports. China is the biggest commodity export market for Latin America, and a key supplier of manufactured goods to Latin America. So China is a big player in South America, basically. And I think for US to be realistically a bigger partner for these countries, they have to come up with actions rather than just words and some military exercises, right? They actually have to do the trade. They have to provide a market for these goods, and et cetera, et cetera. So it can't be just Trump wanting it. It has to be kind of a thought-through process and program to get there.
But I think that is a little bit separate, though, is it not, to the repositioning of North America and South America? Because it's not like obviously when we talked about tariffs, and they started happening not this time last year, but a little bit later this time last year, and the argument people had against tariffs at the time was that, the US aren't suddenly going to start producing T-shirts and it's going to start producing, plastic goods of little toys and things like that to then therefore consume locally or export globally. That was never ever going to be the case, even though that was the argument used. It was kind of like the discrediting of tariffs was, well, this isn't going to happen. But I mean, to believe then that, a realignment of South America and North America, as per this kind of Monroe Doctrine, which they were talking about, is based on the idea that the US will be importing or exporting cheap goods to Latin America. I don't really see the alignment of the two positions, because I think inevitably you're just going to have this situation where, there's going to be lots of posturing about China, lots of posturing about EU, lots of posturing about US and who's making what goods. And, the cheap stuff, the stuff like cheap T-shirts and cheap shoes and cheap plastic goods is never really going to change, because that's already been shipped out to China in the last 50 years. Already China has dominance in terms of all of that industry. But I think what the US and South America realignment occurring is more maybe strategically, militarily, and in terms of things like oil, for instance, you mentioned, whatever rare materials, aluminium, whatever there is down in South America that is of particular benefit to industrial production in the US, is probably going to be something that they do want to align to.
Maybe. I think economics and, partnerships between countries are interrelated. You can't, in today's world, I don't think you can just say, well, we have a military alliance, so, everything else is not important. And look, these charts, they just show you how involved China is in the economies of these countries. That's all I'm saying.
Yeah.
And for them to kind of realign, say, US has to give something back to do something about it, right? Whether it's the export markets or the imports markets, it doesn't really matter, as long as it benefits both sides, right? And this relationship between China and these countries, it's beneficial.
Like that 20 billion, was there an Argentinian bond or something, or US?
Well, the IMF loan it's basically America's loan,
yeah.
But they also have a swap line, like a fixed swap line for Argentina. So something like that. But trade is better than just swap lines. Building something together is better. Well, at least I think it's better.
Sure,
So it's not. These charts are not saying that it's impossible, but they are saying that there's a lot of work to be done outside of politics, ideologies, and military.
Well, I mean, Paul, I'm excited for the Trump Tower in Greenland.
That would look pretty nice. We have a.
I think that'd be pretty cool.
Right?
I think I think so. Big shiny green or gold tower.
Go?
And I mean, why not? Why not in like middle of Venezuela or somewhere in Argentina, Buenos Aires or somewhere?
Yeah, he likes his gold, doesn't he? The building is golden.
Yeah, there's your trade. That's your that's what you get.
Yeah, look, it's. I think in terms of Greenland, I think there are reasons why it's not as developed, right? In terms of resources and mining and stuff like this, and I think the reason is it's super difficult to mine in that place, so the costs must be very high. I think it's one thing to have like a military base there, and it makes total strategic sense if you look at the map, right, for US. But actually getting the minerals and mining for stuff, it's not going to be easy. Otherwise, it would have been done already. It remains to be seen what actually happens. If it's just Cyprus-like arrangement where UK has some land with military bases, for instance. It's not. It doesn't allow you to mine the stuff, right, and take it away. It's purely strategic in a military sense, I guess. So I think I do like energy. I think energy will be an interesting place to be because of all the AI stuff and the underinvestment, lack of capex for a bunch of years. It's a hated market, as I've said. And it's not just oil. It's also coal. It's nuclear. It's nat gas. Things like that. I think there are a lot of interesting opportunities in the equity space there. I think commodities in general, as I've said, will be the place to be. So I would say some exposure to this is valid, is a valid approach to have some of that. I think emerging markets will outperform developed markets as they have in 25. I think Europe could be an interesting one. I keep hearing my American friends investing in Europe, in European companies, and getting out of the dollar kind of thing.
I saw a rumor though. That one's interesting because we talked about Europe the last time, and the biggest frustration I have is everything to do with Europe, because I think it's just like this inert, over bureaucratic, over regulated entity. To be honest, those are my true feelings, and it's like, there's so much potential. There always has been so much potential here, but it's just completely flat, and it feels flat. And I saw a rumor there yesterday about that Rolls-Royce are potentially moving out of UK. That's 40,000 jobs moving to the US to set up further jet production, production of engines over there. And that's a seismic move. And then last time we talked about Europe, and we talked about industry in and out of Europe, and obviously you had some statistics. For anyone that is interested in this topic, they should revisit that podcast. But you had some statistics talking about, European industry isn't actually as dead as we think. But then at the same time, you hear of the likes of Volkswagen wanting to move out of Germany, and were announcing they were doing so. And one of the big byproducts actually of this World Economic Forum that's taking place in Davos at the moment, and the fact that the US went in and basically lit the place on fire. One of the biggest outcomes and potential positive outcomes of that is I saw Merz, the German Chancellor, this morning saying that Europe has failed in terms of its governance because it's over bureaucratic and literally, quote unquote, over regulated. And that has been the biggest frustration for me, that it's like things don't really happen in Europe despite a population of 100 million more than the US. And I do hope you're right. I do hope that in the likes of Europe has a future ahead of it in the coming year, and things start changing and there's more momentum rather than talk, because it feels like in Europe we've been quite good at talking and commenting on the US and commenting on what the US are doing, but in terms of actually progressing here, it's been quite limited.
Maybe it's time for Europe to look in the mirror and fix the hairdo.
Yeah, more than just the hairdo. There's an outfit change. There's an attitude change.
Some lipstick.
Maybe a new beard, lipstick, the whole shebang.
Yeah, some change for sure. Look, for me, it's just a valuation comparison type of exercise. You mentioned Volkswagen, but it's a global company. When you invest in Volkswagen, you're not investing in Germany, really. You're investing in the brand, in their approach, in the way they do things. Rolls-Royce, I'm not sure. I haven't heard this, but we did touch on electricity prices and, industrial power prices in UK last time, I think it was. And they are abnormal. They're not competitive. So I'm guessing that's the main reason. It's not the ideological push. It's just like an economic decision. And it sounds like it's the right one. Yeah, we like Europe. We invest in Europe. We have the same approach. We try to stick to systemic companies. Some miners, you have them in Europe as well, or global businesses that happen to be from Europe. So European bonds too. It's not like we're all in on Europe, right? If, for instance, if you compare our allocations to Chinese companies as opposed to European ones, China is the bigger chunk of our allocations, for example. And by the way, I think China still offers some interesting place like value propositions, miners, etc.
Oh no, absolutely. Like I mean, even from a layman's perspective, like me, it's like China. It was funny when you compare the green agenda in Europe versus the green agenda in China, and it's like in China they understand that it's green infrastructure and green ideas and green investment and green production, whereas in Europe it's the green stick, i.e. the green punishment or
the green bureaucracy.
Yeah, exactly. Green bureaucracy, and it just is like incredibly frustrating because they actually know how to do things in China, whereas it becomes overly bureaucratic in Europe, sadly.
Maybe we just need a little bit more time. I'm a big believer in Europe. I think we'll kind of power through, and maybe Trump's actions is going to be the catalyst for that. Who knows?
I think it will, if I'm honest, and I think a lot of people are very upset about him, which I get. But I actually think it's you have to crack the eggs to make the omelette, and I think even the fact that Merz this morning came out in Davos and said that about that Europe is overregulated, that is a pretty good sign, I think. I agree. I just one final report I'd read on this, and it was a Blue Skies perspective. That it was from Brown Shipley, this bank, European-based bank, UK-based bank, that they said that four forces will shape the market environment. One, the expectation that trade tensions between US and China will ease, like the rivalry will ease down, which has a potential to affect earnings and growth in some European countries. Two, their second point was governments keep supporting growth via fiscal stimulus. Three, central banks potentially cut interest rates, and four, and AI investment continues to support growth. So they painted a perspective that there's quite blue skies on the horizon, which I have to admit I actually do agree with. I think there is blue skies on the horizon, whereas previous times we had concerns about recession and potential collapse and potentially everything falling in on top of itself, whereas right now it's like the chaos, and out of the chaos you kind of have a bit of the blue sky, don't you?
Yeah, catharsis, right? Kind of thing.
Yeah.
I think that's about right. I think fiscal is going to be a big GDP contributor for European countries. We actually have a chart on this, part of it anyway. It shows public infrastructure investment in Europe, and you can see it's been going up. The gray shaded area is the projection, obviously, but I think it's one way to get the economy going for sure. We've talked about these plans in Germany before in our last chart. So, but it seems to be happening Europe-wide, and that's definitely positive. It's actually investing in something tangible, whether it's roads or bridges or whatever, something that stays, something that generates jobs and wages. So I think we'll see a lot of that in the coming years, and I think it's positive, So another reason to be interested in Europe, at least, even if
That's
not
true.
invest. So these are my kind of ideas about how to go about investing in 26. There are obvious risks to that. I don't think we should kind of dwell on those. What do you think? Maybe it's a good point to finish off.
Yeah, I think so. I think, Paul, we've done so much of so many different topics in this discussion, and obviously to understand the overall how the cake is made, you have to appreciate all the ingredients, and we're trying to do that in these discussions to try and understand every different angle. But you've given a fantastic insight on so many different areas, and I try and push back now and then as a layman, and sometimes expressing my own personal opinions, but I think that's pretty necessary in order to find the truth as well. I think this is a good place to leave it, and What do you think?
Yeah, I think we've covered a lot. I think it was a good time to look back at 25 as well, because, and I want to stress this again, these things that we kind of highlighted, they could be critical going forward. So things like the dollar moves, the EM dynamic, what's happening with the monetary side of the equation in US and globally. These are all kind of pieces of the puzzle, and they're very important. And I think it would be like if there's one thing I would like for our viewers and listeners to take away, is that it's super important not to project what has been to what will be in a linear fashion. These are very different times, and I think it's a critical mistake that people make. They just project in a linear fashion of what has been. These are different times that take a different approach to be successful. Also in investing, but generally.
That's very true. Stay humble and don't project in a linear line.
That's my take on what you need to be successful, I guess.
Yeah, that's your catchphrase. The aquarium man, Paul Melamed, when he flies in to save your portfolio, will say, stay humble and don't invest in a linear line.
Yeah, and don't panic. Never panic.
And don't panic as well. Okay, I think that's a pretty great place to leave it. And I've really enjoyed the discussion, and I've learned a lot. So thanks a lot, as always, Paul, for the discussion and chat.
Thank you.
And we'll talk again soon.
Thanks to everyone for listening, and see you again soon.